Good morning. Good morning. Hope everyone out there is doing well. We're just getting ready for this week's edition of Back to the Futures with me, Markets and Mayhem. Good morning, folks. It is Tuesday, March 31st, 2026. It is time for this week's episode of Back to the Futures. First thing we always like to talk about is risk management, because if you are to survive in the markets, you need to appreciate risk management at a foundational level. It is the most important part of your journey. Some people have to blow an account at least once to learn that. I'm hoping if you're listening right now and that hasn't yet happened to you, that it doesn't have to happen if you can take this lesson and really build on it. And what I mean by that is when you put on a trade, do you size it based on the amount of risk that you're willing to take? That is to say, Let's say you're getting into Bitcoin. Are you taking a smaller trade on that because it's a more volatile instrument than, say, something like a US Treasury note future contract? Because if you're not sizing positions based on volatility, then you're gonna start to realize that over time, the behavior of different instruments is so different, you can't trade them in same size. So you may as well start to appreciate that earlier on in one's journey. If you're already doing that, that's awesome. The math that I like to look at for that is very simple. Get an idea of an instrument's inherent volatility. You can look at realized volatility blended with implied volatility. You can look at other things like average true range, but get a sense of an instrument's volatility. Then, when you're placing your stop, you're looking at something that goes beyond the normal volatility in that instrument. So, say if its volatility average is around 5%, you'd probably want to take a stop at 7% or more on that instrument. Well, if you're trying to aim for 2% or less of total portfolio drawdown in a trade, now that you know that your max drawdown on that is 7% or more, because you can get your stop run right through by the market, you size that position accordingly. And that way, for things that are more volatile, you have a wider stop, take a smaller position. For things that are less volatile, you have a more narrow stop, so you're able to take a larger position. That way, you don't get chopped up the same way. You have more opportunities, and you're sizing and managing risk based on the inherent volatility of what you're trading. It's one of the best ways to avoid the fourth shape that really no one wants to experience. And that's why I like to give this little talk on risk management, because at the end of the day, I think it's the least appreciated part in trading for people that are new to the game. They think it's easy path to riches, and maybe for some it is, but they're the outlier. That's very rare. It's much more likely, and I think everyone should get into the mindset of there's hard work here. You've got to learn more about yourself. You've got to learn more about the markets around you and develop a system that allows you to trade it with some degree of consistency. That consistency is eventually what the edge that you'll build will become. That's how you start being able to actually trade with some degree of confidence as well, because you build that consistency. Then, if you're taking a more systematic approach, you have the confidence to see your trades through. You're not going to sit there and take a profit at the moment that something turns green. And then on the other side of it, you're not going to second guess yourself so much to say, I'll just ride this loser. Eventually, it'll come back. It's a really important part of self-discipline to get that confidence in signal generation, which is why I also think systematic trading, it's so much less of a head game. That is to say, with discretionary trading, you're not only trying to manage your book, you're trying to manage your mind. If you take systematic trading seriously, a lot of that emotion is not part of your decision-making process. It doesn't mean you may experience it, but you don't have it color how you execute. And that's a very important part, I think, of coming to appreciate that trading really should be boring. It shouldn't be a constant dopamine rush. It shouldn't be a lot of adrenaline. It shouldn't be make or break your account every time you're in a trade. Like, it might feel intense doing that. I guarantee you several things will happen. One, you'll burn yourself out. Two, you'll build really bad habits. And three, you'll eventually blow up. And the thing is, when you hurt your account, it's actually quite hard to get back to break even. The bigger the loss you take, the harder that journey is to make. And that's one of the reasons that I really like to emphasize this chart, because you can see if you're limiting your losses, it's easier to get back to some degree of, breaking even or even profitability. But once you start taking losses, especially over 20%, the math becomes so much more difficult. So this is one reason that it's also really important to both cap the losses in individual positions and the total portfolio. That also means be really careful with leverage. If you're new to this game, my sincere advice is avoid it. Until you have a system where you're consistent and you understand exactly how to trade your system, you have journaling, you have experience, you have confidence, you have signals. Don't even think about leverage. Leverage is just going to cause way more second guessing of one's own mindset. It's going to cause way more risk to your portfolio. And it's a much more difficult situation to manage because you can have positions that get you margin called. So my thought is unless you absolutely need to, and most people don't run leverage. Not until you know exactly what you're doing, you could build on it, and even then, I would say be extremely careful with it. So a bit about me, I've been doing this for 21 years. I love it. It's been an incredible journey. Like any other journey, there's been ups and downs, but the market is a school. We're paying tuitions to that. Every time we have a loser, we all have losers. We're paying a tuition to that school, and it's up to us to learn the lessons being taught. That's one of the most important parts of coming into your own in this market. It's not just the idea that you've got to learn and you've got to grow. It's that you've also got to learn from the things that don't go well. In fact, I would say that's one of the most important areas to learn. Confront your demons, get over your ego, figure out the kind of trading strategies that don't work for you, because the things that work for someone else, including me, may not be the most ideal for you, but we can still learn from each other. We may trade different time frames, different assets, we may have different ways of approaching our execution, but we can all learn from each other. And I think that's one of the most important parts about trading, rather than getting into conflicts about who's the best at this or that or whatever the case may be. And there's so much drama on Twitter and other places all the time. I try to stay clear of all of it. I just want to stay in my lane, do my thing, make some money trading, build some tools, have some fun, teach people. That's kind of the way I look at it. But at the end of the day, I think that if you can get out of the whole ego driven mentality, the whole fear and greed driven emotion that causes people to go on tilt, if you can tune that out and become more of a serotonin rather than dopamine driven trader, you can build on that. You can build real experience and consistency on that can take you to that level where you start building an edge. And I think that's what it's really all about. There's a lot of people that advertise fast riches and lottos and Lambos and all that sort of stuff. And I'm going to tell you right now, that's pretty much all fake, if not all entirely fake. A lot of people are posing in front of rented cars and houses and advertising wealth they don't have so they can sell you something you don't need. Usually it's $1,000+ course. Don't buy any of that stuff. There's more than enough content out there that is extremely cost effective or free to learn more about trading. Like what we're doing every week on these streams and the other streams that the Bookmap folks have, just as one example. Plenty of great free content out there. So, you don't need to go out there and buy some super expensive trading course sold by someone posing in front of a Lambo that isn't even theirs, because it won't get you to the next level. It might even cause more confusion than help. And with trading strategies, like anything else, if you don't actually take the time to practice it, then you're not going to get anywhere. That's one of the most important parts of this game, by the way. You have to be disciplined about how you approach it. It's not just get in there, wing it, and then come back the next day and hope you still have an account. You know what I mean? You've got to journal those trades so you can figure out what's working, what's not working, where you can improve, where there are weaknesses that should be addressed. That all builds up over time. I have a journal. I review it every Friday after the market closes to get a sense as to what worked, why did it work, what kind of mindset was I in, what kind of trade setup was it. And I've been doing this for 21 years. I still keep a journal. I still find room for improvement. That's one of the best things about finance, by the way. There's always room to learn more and to improve. Should keep you on your toes. Now, if you didn't sign up to do a lot of hard work, if you didn't sign up to, run trading like a business and manage it like it's, you're buying and selling inventory and trying to capture a positive spread, if you didn't sign up to put in that level of effort, then I hate to be the one that breaks it to you, but you might not have a good time. On the other side, if you did sign up to take this seriously, if you're willing to put in the effort, then it's more likely that you're going to be one of the statistical outliers that succeeds, because about 95% of people fail at this game. You don't have to be one of those people, but what you do have to do is be willing to put in the work. So that's my soapbox sermon. Now we're going to get on to some charts. First things first, as always, over the last month plus, we've been talking about the Iran war. It's on top of mind. We have headlines back and forth every day about this, and it's largely really about this one small body of water, the Strait of Hormuz, where about a fifth of the world's oil supply transits. It's also becoming increasingly about the energy infrastructure of neighboring countries because that is also coming under attack. The point being, all of this is disrupting oil supply. This is a problem. It's one of the reasons oil is bid into the triple digits. It's one of the reasons that we see rates pulling up on the long end because inflation expectations are starting to increase. And it's also one of the reasons that equities are under pressure. Because unlike some wars where the market can kind of look at this in the rearview mirror and focus more on what's ahead of it, this continues to draw our attention because it has the potential to get worse, to escalate, to become more of an entrenched regional conflict. And over the last week, back and forth, we've heard from our president that maybe he doesn't care about opening up the Strait of Hormuz. Maybe he's okay with just leaving. In fact, we heard that again last night. That would not resolve the structural inelasticity in energy supply. Because if the strait was to remain closed or bottlenecked, you're still going to have a lot of inelasticity in petrochemicals and the products that come downstream from them, fertilizers, medicines. There's even a shortage of helium because that's a byproduct of natural gas production, which is also used for making semiconductors. So there's a lot of different things we have to keep top of mind as long as the strait is effectively closed. And as the longer it remains that way, the more that these problems become things that can lead to cost push inflation and supply chain disruption. The other thing that we have to be aware about with the price of oil being as high as it is that there is an element of cost push inflation that is near statistically certain to occur. This first shows up in CPI energy month over month and year over year, and then it's going to start permeating into other areas of inflation as it's measured in PPI and CPI, in PCE, and not just here, but globally. In fact, we might be lesser affected than a lot of other countries around the world that are really going to get hit harder by this early on. This whole situation, the tension behind it, has caused dramatic de-risking in US equities. If we look at hedge funds, for example, they have done the most aggressive selling since the tariff tantrum of 2025 and the third most aggressive in the last decade. That's a lot of de-risking. In fact, I've heard it's the third most aggressive in 15 years. So that gives you a sense that we are getting closer to a point where, at least from a tactical perspective, one might be buying a dip to cover shorts or to start building an entry position. Because we're starting to see some things that show us there are extremes at play here. Another is this, the global long-short ratio. This is also at an extreme. I believe it's at an extreme not seen in over 2 decades. But at the end of the day, this gives you a sense this is still a well-hedged market environment. This is a market where a lot of the institutional participants have various strategies, mostly at the macro level, which means index, sector, industry level, where they have these hedges in the form of various short positions, whether they're things like puts, whether they're synthetic strategies like swaps, or maybe they're shorting tranches of ETFs. All of these types of strategies are close to being maximally short or hedged. This is a value at risk technique, by the way. It simply means that we don't have participants that have to forcibly de-risk into some of this downside because they already have the fire insurance and they're a little bit more comfortable as a result. That means when the market declines, you're less likely to get really sharp moves. You're more likely to get bounces off declines, and you have more of a sort of distributive, sort of consolidation feel behind the top level price action on a daily chart, which certainly we have. It's become more distributive of late, but I guarantee you, if this market wasn't as well hedged as it had been going into this conflict, we'd be down 15 or 20% here. So that's part of the buffer effect. And another thing that drives home this idea of being well hedged is the ratio between implied skew and realized skew. So realized skew, or the realized up and down volatility, is much lower than the implied skew. This is telling you you've got a market that's planning for more volatility and more downside than what has occurred of yet. So again, more evidence of a well-hedged market. This is a great chart from Nomura. We also have this, which gives us a sense that maybe technology is becoming cheap, at least on a relative basis. And this is something that, to me, I think we need a catalyst. We do need to see something that helps to improve, say, the Gen AI narrative, the CapEx story that a lot of people are concerned about. Maybe we see some more efficiency gains. Maybe some companies pare back a bit. But I think that we're getting closer to a buyable dip in tech itself with what we're seeing on charts like this. Also, what's up with Thursday? Does anyone know why we've seen 9 consecutive weeks of sells on Thursday? Are we gonna get the 10th consecutive week in 2 days? Is that gonna happen? It's incredible. This is the most that we've seen, I think, ever for the S&P 500 in terms of consecutive Thursdays in a row, if this week has another Thursday sell. We're tied right now to 1998. Now, some folks might say, oh, well, this looks like it's a bear market in the making. Remember that in 1998, the market still had a lot more upside to process. And during that really brutal dot-com bust, you could see the Thursdays in a row with a daily decline were far more low. So this isn't necessarily a sign of an imminent bear market, but it is at least a sign of a market that wants to de-risk more towards the end of the week. Perhaps that's a bit of a sign of, people being more concerned about these weekend escalations. Another sign of maybe we're getting closer to that buy the dip moment is this chart here from Goldman Sachs, where when a geopolitical event is unfolding, just a little while after that, the market's able to look in the rear view. Now, for me, I think that the qualifier is, are we able to make progress on the Strait of Hormuz? If we are, that's a very buyable dip. So that's the one caveat to this chart that I want to add in. But everything is showing the same sort of signs that there's a lot of extremes underneath the surface. There's a lot of re-rating that has made certain areas of the market more attractive. And I think we have to keep that in the back of our head. Look at a shopping list. If we've got cash to deploy, we can't ignore some of these things that have happened. We just need to look for some signs, some catalysts that this thing is really going to turn around from here, that we are actually going to see a de-escalation and not just more vacuous headlines about peace talks that then inevitably lead to another escalation and then another, ceasefire talk and then another I mean, that back and forth is kind of desensitizing the market to the headlines more and more. But when we see real progress, which would be, in my mind, not the headlines, but traffic in the Strait of Hormuz increasing meaningfully off the lows for days at a time, that would be a much more meaningful sign, and that would be something that goes well beyond the headlines. Technicals and momentum, starting off with the S&P 500. We are not out of the woods yet. Now, we are back to last summer's lows from August to September. This could be a kind of durable area. It went a little further than I thought. I thought we'd get a better bounce off the November lows. We didn't get it, but maybe we're closer to getting it here. Again, it's going to be about progress. This could end up being a longer conflict. It could end up being a longer disruption in the strait. If that's the case, the idea of a bounce to anything other than a lower high kind of goes out the window. But for now, the line in the sand for me on the support side is the lows from last summer, the August-September lows. And then on the resistance side, it's really this moving target, the EMA 21. If we can bust above that 21-day EMA on a weekly close, I'm going to say we're likely to get some solid continuation out of a move like that. The NASDAQ has a very similar look. It also sold down to the September-August lows of last summer. And also, I do want to see it break above the 21-day EMA on a weekly close. But first, we have to see how we can hold this support. This is still a market. This is still a chart where both the NASDAQ, the NASDAQ, the Russell, the Dow, the S&P, all of them, they look heavy. But the last two charts, the S&P and the NASDAQ, look quite heavy overall. These are really the market leadership indices. So we have to see them rebound. And given the weight of tech, the NASDAQ really has to lead this thing higher. I know there's been a rotation, and that's fine. There's other parts of the market that have done better this year overall, including things like high dividend stocks, defensive stocks, of course, energy stocks, But at the other side of it, tech needs to lead if the indices are going to recover. It's just too big of a weighting otherwise. Shifting gears over to gold, we had that look down to the 200-day moving average, got right close to it and bounced. I think on some people's screens, we touched it. Either way, I like this as a validation that there are buyers down here defending this level. I think that gold has probably seen the worst for now. We've shaken out a lot of the weak hands in this trade, which is great. That's exactly what we needed to see. But on the other side of it, now we really do need to see buyers continue to build on this low to make it really look like a convincing reversal to get more of the momentum traders that were shaken out by this sell to come in and buy back at higher prices. That's how we get continuation. Anytime you have a crazy move like this, by the way, it more than often has a continuation move like this. That's to say, parabolic moves tend to end badly. And while you might have a rapid ascent, you typically have an elevator shaft trip lower. So that was that initial flush. Then we had sort of the fake recovery to a lower high, and then another a little bit more orderly flush here for the most part. These two got a lot of people out of the long gold trade that were more speculative, momentum traders, etc. So we're looking for gold to continue rebuilding that momentum so those same folks get drawn back in. It's a similar look with silver. Silver's got, and this is a weekly chart to be clear, but it has a similar look to gold. It had a really powerful parabolic move and basically crashed. Then it had that sort of fake recovery that made a lower high. We broke down below the 21-week moving average. Now we're starting to break back above. You can see this has been kind of an important indicator for silver. So I do like the 21 EMA on the weekly for silver. We are pushing above it. I'd love to see us close this week above it to get a sense that maybe the worst is over for silver for now. A part of that will also come down to the straight to a degree. If oil prices remain high and there's shortages, you may have less industrial usages of silver during that time. You may have projects that are put on hold for all variety of reasons. And then, of course, how could we talk about all this without talking about oil? We have crude oil on screen. I do want to mention Brent for the month of March is up nearly 60%. That is the biggest monthly gain for Brent ever. So just giving you a sense as to what's going on in oil and how big of a deal it is, the pass-through impacts that that can have over time are enormous should these prices stay high for long. For now, we have West Texas Intermediate crude oil. It is also treating the 21-day EMA as a really important momentum indicator. We can see that the last time it tested, it had a strong bounce higher. This time we got a retest, and it looks like we're in the early innings of another strong bounce higher. And I got to level with you, I would not be too surprised to see this thing going to all-time highs if the strait remains closed for that much longer. Maybe another 2 or 3 weeks, maybe less, but it seems all but inevitable, especially if these alternative pipelines get hit or otherwise don't function with the amount of capacity that is desired. Bitcoin continues to look pretty tragic to me. This is an older chart, but it's the same pattern that is still playing out in Bitcoin. So I'm still thinking we're looking at 52,787. And then the US dollar remains formidable. This is one of the big ones we want to watch, whether we're long precious metals, US mega cap stocks, emerging markets, or their debt or currency. All those types of trades tend to do poorly when the dollar is faring well. This is a bounce off of a decade-plus trend line that takes us back to the great financial crisis. It's formidable. I know we like to joke that technical analysis is really just astrology for gamblers and we're just putting crayon lines on charts, but there is some real fractal geometry here to this trend line. And so far, the support that's coming in is part of the reason we've seen pressures in some of those other markets that I've talked about. One of the areas that would give us some reprieve from this rise in the dollar would be a drop in long end rates. And the only way that's really going to happen is if oil comes down. It really does all come down to oil here. And here are this week's pivots. You're welcome to share those. I'm going to pop them on my Twitter feed as well. And we also have some options levels to watch. All right, so that's out there on the feed. And we'll talk about some options levels, and then we're going to get right into Bookmap because we are pretty close to the market open here. So these are the SPX options levels from the visualizer. These are levels that my algorithm comes up with looking at over 10,000 contracts across the chain. They're updated throughout the trading day, and they can be pretty helpful because they often act as support, resistance, or magnet levels. So I'm putting that out there on the feed as well for folks. You can also take a screenshot if you'd like. Of course, we do have some awesome deals for you all. You're welcome to check out Traderade with a 20% discount. Offer ends soon using the code Mayhem20. And you can also get up to 40% off of Bookmap visiting traderade.com/bookmap. Scroll down to the special offers. And one thing I always like to say, folks, no matter how the market is treating you, whether you're killing it or whether you're getting killed, please treat yourself well. That is one of the most important parts of the trading journey, to not burn yourself out. You can't tie your emotional well-being to your portfolio, to your P&L, or any of that. Obviously, if you're doing poorly, you've got to take action. You've got to hold yourself accountable, but you can't just beat yourself up and hope that, emotional self-abuse or whatever, it's going to help. On the other side of it, if you're doing really well, that's great, but don't let it get to your head to the point that you think you have the Midas touch and you can do no wrong and you start taking really silly risks. All of this is about staying focused. What is the long-term goal? How do we get there? Building steadily over time. So let's dive in to Bookmap. We've got that on screen here. We've got just about a minute till the market opens. And we do have some data. We did get US case-shiller 20 year over year. That came in this morning lower than expected at 1.2%. We get Chicago PMI at 9:45 a.m. with a forecast of 55 and a prior 57.7. And at 10 a.m. we get US JOLTS job openings, I should say, with a forecast of 6.89 million, prior reading of 6.946 million. And at 10 a.m. as well, US Conference Board consumer confidence, prior reading of 87.9, a forecast of 91.2. Also, a slew of Fed speakers, as if we missed them. They are back in force today with Goolsbee, Schmid, Barr, and Bowman starting at 12 p.m. The parade resumes. And we're going to zoom in just a little bit more for the market open here. There's such a cross current of institutional flow here. It's kind of fun to zoom in, see what's happening as they trade blows. Essentially, you've got a lot of orders from the prior day that have to be executed. You've got decisions that have been made overnight, or you have desks that have to put these orders through. And there's two windows in the day that this happens from institutions. It's really the first and last hour where the vast majority of institutional volume is transacting. And that's one of the reasons you have studies that look at this. You've got things like the opening range and initial balance, because we're really mapping out that flow. It helps to set the tone for the day. For example, if you have a narrow opening range, you often have a less volatile trading day. If you have a wide opening range, you often have a more volatile trading day. So things like that can help us set the tone, and it really has to do with the amount of back and forth that's happening as this session opens. And most of this rejection off the high isn't really sellers getting aggressive as much as it is buyers stepping aside. RK, that is a cumulative study on icebergs, and it's looking at what's happened during the session time frame that's available on screen. So you can see since the market opened, there is a distribution of 902 icebergs on a net basis, which gives you a sense that there was some passive selling into this market. So let me know if that's helpful contextualizing it. I'm not sure what that other book map might have been looking at. They might have had a different time frame in play for what they're studying, but for the way I look at it, I do like to really look at the session time frame since it's going to show me the icebergs that relate to what I'm seeing on screen. So again, a bit of a recovery off the low. Again, that sell wasn't really aggression on this part of the sellers. It was really more just buyers stepping aside for a moment, maybe giving the sellers a chance to just show how determined they are. So they took us down to just above 64.50. Now we're trading back to the top of the range. It's kind of the opposite. This time, sellers just stepped out of the way for the most part. Buyers are trying to make a bit more of a push here. Still negative on the iceberg, still have passive distribution, even just then into this tape. Nothing too significant yet, but worth noting. And good morning, everyone that's tuned in. Tom, Yosef, Jeff, Javier, No Fears, Antono, Big Bear, RK, Stock Market, Intratrade. What's up, folks? Hope y'all are doing well out there. I'm going to take just a slightly larger time slice as we get further away from that open. And pretty soon we'll start to see some of the flow coming through and hitting the tape. But at the very least, we can also start to see some of these key options levels that are still on the book. So likely is a case that we could have some resistance up here, especially at key one positive. So we'll zoom out. We'll keep that on screen though. Starting to see sellers get a little more aggressive here. All right. So really just kind of carving out a narrow opening range here. It's not terrible, about 15 handles, now pushing it to 16, 17. 10 minutes into the 20-minute opening range period I like to watch. And we're just about 5 minutes away from some data that may move the market a little bit. That's US Chicago PMI with, again, a forecast of 55 and a prior reading of 57.7. And getting a bit of a push here. I didn't hear you, Dan. All right, very good. We are pushing up to the top of the range. We're seeing a little bit more distribution on the icebergs, and that net reading now negative 1218. And that data is dropping in just about 3 minutes. You can see the order book has thinned out a bit here. This is one of the reasons you need to be careful about managing risk into these event volatility catalysts. Because right now, there's less liquidity to absorb whatever move happens, which means, for example, if you have a stop set and a big move happens and it's not very liquid, you might not have that stop come in at the level you were hoping for. You could get stopped out with more of a loss. So be careful trading during these times right as we're bumping into an event volatility catalyst. Often is the case, the best practice is to not have anything on or just not be actively trading through that event because you can have moves that get exaggerated and we already have liquidity that's relatively thin in these markets. Pushing up to a new session high here. Some more iceberg selling. You can see there is passive selling into strength throughout this tape from the open until now. I think that's something to keep top of mind. We see that pattern continue. It just gives you a sense there's a desk out there that is either fading this move By taking a short, we're at least taking profits into it. I would also say that having a market bid on the idea that we're going to leave the Strait of Hormuz closed is really kind of silly. I think it's more of just a bounce off oversold conditions than a all clear type of thing. Data is dropping in just about 1 minute. Again, that is going to be US PMI data. We have US Chicago PMI with a forecast of 55, prior reading of 57.7. After that, we get JOLTS and CB consumer confidence at 10 a.m. Eastern. Market's pulling just a bit ahead of that data. We can see some updates to the options positioning. We've got a call wall just over us. That's going to be formidable resistance today in all likelihood. Starting to break below the point of control here as well. For those not familiar, that's the level where most of the volume has transacted on the order book for the session in question. And PMI data is out. Chicago PMI coming in at 52.8 versus a forecast of 55 and a prior reading of 57.7. So lower than forecast. We also have Marvel and Nvidia making a deal, which should be a bullish catalyst for those companies, and particularly Marvell. Getting a bit of a bounce off of that test of the point of control here. And so looking at the session so far, and again, I like to trade it really looking at two areas of focus. The 20-minute opening range to get a sense as to how dynamic the trading environment might be for the day, and then whether or not we're able to make a break above it, suggesting we could have more of a trend day than a reversion day. And then the other side is the options flow. We haven't yet gotten a lot of that hitting the tape yet, but that also gives me a sense as to which side might have more influence. Now, obviously, it's not as simple as just looking at two variables, but those are two variables that I keep top of mind, particularly earlier in the session. Because if creating a nice 20-minute opening range, 15 handles or larger, building above that opening range, building acceptance above the top of that opening range, and seeing call flow well in excess of put flow in the most active strikes of SPX. All that would give me confidence that we could probably see that opening range extension hit that most active call strike. So that's that setup. You're taking two different areas to validate what you're looking at. Is this going to be a dynamic tape? Do we have a potential trend day? And then where's that continuation going to come from? Where's our upside price target? And you can use opening range extensions as well. There's nothing wrong with that. But I have found that looking at where there's the most interest in the options that are the most active, so the strike and the most active strikes can be pretty magnetic in this kind of a tape. You don't have a lot of depth in the order book, but also we're deep in negative gamma territory. So we have this chase dynamic. And what that means is dealer hedging changes a bit. You're more likely to see them chase rallies and sell dips. So you have a vol catalyst built into being in negative gamma. And we're pretty deep in negative gamma. In terms of the way the math works, we're about as deep as you can get. Like we've basically reached the point where it has the maximum impact. So you have to account for that in position sizing. It does mean size down a bit, widen stops a bit, be careful because you're going to get not only this headline risk, but also this erratic tape risk. And this is actually now turned into a pretty solid opening range for today's tape. Looking at about a 26 handle range in the S&P. Handle, point, those are interchangeable terms. If you hear me go back and forth, it's just because I've been trading this thing with people that were referring to it as such, because that's the classic floor trader term, handle. But point, handle, interchangeable. We do have liquidity above us here. It tells us two things. There's both interest in higher prices and the market's testing auction theory here. Do buyers have enough demand to make a push through this offered liquidity? If they do, and they do it with some degree of aggression, that gives us a sense we could get some continuation. We should also, yeah, we're starting to see some continuation coming in here. Was that a headline? There's a lot of volume that just dropped there, basically like a little tape bomb. Also got some calls building above. I'm just zooming out to show that. We've got the two most active call strikes up here starting to build a little bit of flow. And we are testing above our call wall level here. We can see liquidity continuing to build above, suggesting buyers are interested in higher prices from here. This also extends our 20-minute opening range. It's now become like a 35 handle opening range. This is a pretty solid opening range. Still waiting to hear what the catalyst is. There we go. We got nope, nothing on the tape quite yet. But that was a little bit of exhaustion. This is my exhaustion indicator firing up, showing that there was just a little bit too much aggression on the buy side for whatever happened there, based on the way the tape had traded up into that event. So that's just something to give you near term a heads up that you could see either some consolidation or a bit of a dip off that. And in 9 minutes, we are going to get two bits of data that could be more market moving than PMI. That's going to be JOLTS and CB consumer confidence. We have here formed a, and I'll just get that off screen. We've formed a pretty wide opening range. I expect this is likely to be a dynamic trading day because of that, because we're also deep in negative gamma territory, and we have a market that has some degree of oversold conditions, some degree of seller exhaustion that it might try to work off. So any positive catalysts are likely to be exaggerated in this type of an environment. And that's for some of the charts. That's for reasons that I explained in some of the charts from earlier. So if you haven't been tuned in this whole time, check out the beginning of the session. I go through some charts that are more zoomed out macro level stuff about positioning, flow, kind of how we've beaten things up a bit here. And we could be primed for a bounce with any decent positive catalyst. Obviously, the idea that we're going to end the war and just leave the Strait of Hormuz closed as a positive catalyst doesn't have a lot of durability. But if there are more realistic ones, that could certainly send this market meaningfully higher. So we did get some consolidation after that exhaustion event from the buyers. We did push above the call wall. We're building some acceptance above it. It does look like we have some healthy flow starting to pick up on calls. There is the midpoint on screen. I would like to see the call flow pick up to the degree that my SPX options visualizer removes that midpoint. That midpoint telling us that flow is pretty balanced overall. So that would just give this move a little more credibility that we could get up to that most active call strike. We did get a good push again above that call wall, built some acceptance above there. Also have a really large opening range. I mean, this is like a 36 handle opening range. So that suggests we could have a pretty dynamic trading day ahead of us. And we're just about 5 minutes away from market moving data, US JOLTS job openings, and US conference board consumer confidence. So JOLTS, we've got a forecast of 6.89 million. Conference board consumer confidence, we've got a forecast of 87.9 million. Ahead of data, we are seeing some signs that this move's getting just a little bit extended. I'm seeing that on some of my off-screen indicators. The other thing is the iceberg sellers have continued to push, now negative 2,838. So it is interesting just to see that even into this move, those passive sellers have been distributing. And we've got a decent offered liquidity level above us here at 6,500. So we got data coming in here in just about 4 minutes. Again, that's going to be CB consumer confidence and US JOLTS job openings. Likely to see the order book start to thin out. So again, if you're trading into this tape, which is so far strongly favoring the buy side, exercise some degree of caution ahead of these event volatility catalysts because it's going to thin out. And with these two back-to-back events, if you have outlier data come in, data that's outside of the range of what the market's really pricing in, that can move things. You can get a pretty choppy reaction too. You can even be on the right side of the trade, but potentially get stopped out because of the exaggerated move as it's a less liquid order book. So just be cautious into these event volatility catalysts. And these are the ones during regular trading hours. Before market and after market, you have to be even more careful. Also, the bigger the catalyst, the more caution. Like, remember when Fed Day used to actually mean something when the market didn't think it was anticipating what the Fed was going to do next? When there was less certainty, when there was more people on edge about it, Fed Day used to have a ton of volatility. And you could be right about the ultimate resolution of that price action and still get stopped out and not benefit from the move. So right sizing your position, knowing when to be in the trade and being careful about your execution, especially around event volatility catalysts, it's all important. By the way, another big iceberg sweeping the tape, another 600 contracts, now negative 32.79 on those icebergs. So there's some larger desk that's continuing to lean into this tape. And on the other side of that, the buy side stops have been triggering all morning. We had 14, 15 buy side stops in net terms. And Treasury Secretary Bessent saying that he believes the Iran war fallout, the economic impacts will be short lived. We'll see whether that ends up being the case. Liquidity is thinning out here. That's the first buy side iceberg that's actually registered on the chart in enough size that it would display that I've seen, I think, all morning since the open. Data dropping in just over a minute here. Again, that's US JOLTS job openings with a forecast of 6.89 million and CB consumer confidence with a forecast of 87.9 million. Outliers are likely to move this tape. So for JOLTS, if it came in over 7 million meaningfully, that could be risk off. It could send rates higher. I know that people are concerned about the economy, but they're more concerned about rate cuts right now. So that's one element to watch. And then similar with consumer confidence, a much better than expected reading could actually be a bit more risk off. As strange as that sounds, sometimes the bad news is the good news the market's looking for. And I think we are in that environment overall. Data in 5 seconds now. Order book thinning out. It has been over the last 2 minutes, but it's really narrow now. And we have consumer confidence coming in better than expected at 91.8, and JOLTS job openings coming in within expectations at 6.882 million. So overall, not too much of a deviation. CB consumer confidence coming in basically around what it did the last time we got a reading, which was 91.2. This was 91.8. JOLTS jobs openings coming in really right within expectations. So, if anything, I think the path of least resistance for this market is higher. I think we're probably going to try to get to that most active call strike. We can see the flow is cleaned up a bit. We no longer have the midpoint on screen. We've got call flow building, and that's the most active strike on the chain. We also had an opening range breakout, built acceptance above that range. So the next thing to watch is the price reaction at 6,500. But if buyers can show demand and continue to push, we certainly see interest in higher prices in liquidity showing up on the order book at higher prices as well as this options flow showing interest in these higher prices. We also broke above the call wall earlier, retested that breakout and continued higher. So overall, iceberg showing us someone's taking profit, but the market wants to move higher. So I think we have an opportunity to do just that today. I want to thank everyone for tuning in to this week's episode of Back to the Futures with me, Markets and Mayhem. I'll be back next Tuesday at 9 a.m. Eastern. See you then.